So financial reporting, the first thing I want to talk about or ask is, again, I asked this in the whole class, but I'm going to ask it again. Your strength and your weakness. Now, maybe it has changed now. I hope it has. If you're able to understand, you will sleep. Then today that you are tired that I'm about to do it.
No. But you see, I've tuned my mind already that so after the time then they forget it.
So today you will catch it.
Today I have to catch it.
Excellent. Alright, so when we talk about financial reporting, key things we need to get ourselves familiarized with, it's accounting standards. There is a 20-mark question on that. So we got to make sure we are okay with accounting standards.
Sometimes it's 30.
Oh no, it's going to be 20.
But 20, it has been more than 20 before.
Yeah, that's once. But then so far, now, it's been limited to 4 accounting standards for 20 months. Then, single entity financial statement. Then we talk about group accounts. That is consolidated financial statement. We talk about interpretation of financial statements. Then, the specialized accounting. So these are the areas that you need to understand in relation to financial reporting. So the first thing is about the standards. As I always say, there are what I call core standards you need to understand before you get to the exam hall. In other words, when you sleep and you wake up, you should be able to understand these accounting standards. So core accounting standards. 1. IAS 16, property, plant and equipment. 2. IAS 36, impairment of assets. IAS 38, intangible assets. 4. IAS 37, provisions, contingent liability and contingent assets. And then 5. IAS 12, income tax. The reason why this is fundamental is that everything that you're going to be doing, from accounting standards, single entity, group accounts, these accounting standards are going to be playing along in relation to that. So it's very important you understand these core accounting standards in the exam hall. So I hope you don't have any problem with these 4 accounting standards. Sorry, with these 4 accounting standards. Right? Okay, that's it. Now, so we come to the accounting standards that we expect the examiner to set questions around. We mentioned that if you look at the analysis, we mentioned IFRS 15, revenue from contract with customers. We mentioned IAS 12, income tax. We spoke about IAS 32, financial instruments. Then we talked about IAS 10, events after the reporting period. Then we spoke about borrowing costs, IAS 23, and then IAS 40. So these are the accounting standards that we mentioned that the examiner hasn't set questions on in relation to that. So these accounting standards also, is there any of them that you have problem with?
So investment property.
Need you wait for me.
Did I even know where you went?
You have started. Favoritism.
Investment property. Financial instruments. So investment property, financial instruments. So the issue about investment property is very simple. IAS 40. The idea about investment property is that when it comes to accounting for non-current assets, there are two ways we can account for it. One, we can either account for it according to the fact that it is used for business purposes, or we can account for it according to the fact that it is held for capital appreciation or rental purposes. So if we are using the assets, the non-current assets for business purposes, then we have to account for it under IAS 16, property, plant and equipment. So this is where we're going to find out about depreciating the assets, whether we are using the revaluation module or we are using what? The cost module. Under the revaluation module, we say the carrying value of the asset is the fair value of the asset minus the accumulated depreciation. But under the cost module, we say the carrying value of the asset is the cost of the asset minus accumulated depreciation. So if we are using the non-current asset for business purposes, we account for it according to IAS 16. And under that, we will decide to use the revaluation method or the cost method. But IAS 40 comes into the picture if we have bought an asset and we are not using it for business purposes. But we bought the asset and we are holding it for capital appreciation. What does that mean? It means, for instance, real estate. You buy a land and you have the land there. So after 2 years, the land will appreciate in value. So you bought the land as a business, but you're not using the land to build anything. Or you've leased an apartment. And the apartment you leased, you are also renting it out. It means you're going to account for that according to us, IAS 40. Now, in IAS 40, because we are holding the asset for capital appreciation or rental purposes, what happens is that under IAS 40, so we're going to be accounting for this according to IAS 40. Now, when we are accounting for it according to IAS 40, we don't charge depreciation, all right, because we're not using it for business purposes. Rather, at the end of the year, we need to test for what? Impairment. Why? Because when we are carrying the asset according to IAS 40 as an investment property, then we need to always carry it at the fair value. We need to always carry it at the fair value. So we need to test for impairment of the asset from year to year. So that is the idea about investment property. Now, the crux of the issue is the movement from an investment property to business purpose and vice versa. So what if we are using a building for business purposes, then all of a sudden we've decided to use it for rental purposes? That switch can also be asked by the examiner in relation to that. So there also you must be on the lookout for in relation to what you need to understand on that. So when you're moving, all you do is that you just calculate the value, okay, the carrying value at the date when they took the decision. Then you find the fair value they placed on the asset. Then if the value here if the value here is bigger than the value you calculated here, that becomes what? A revaluation surplus. So very, very important. Now, when the investment property appreciates in value also, that is a benefit to the entity, and that goes to other comprehensive income. So that is the idea about investment property. That's the idea. Sounds good? So that's all about that.
What have you received? Cost and what? The R
Where?
thing. The R.
Revaluation. Okay. So that is IAS 40.
Okay, and there was something I did somewhere, and like let's say 20 rooms. Okay, and one room is used for business. Then the remaining 19, there's nothing. It's just there. In that instance.
It's just there in the business. What have they done? What decision have they made on the usage of that asset?
What was it like? I think it's rent.
Yeah, if then it's only the parts that they are using that will be accounted for under IAS 16. So the portion that they are using for rentals will be accounted for according to
So we're approaching one over 20 times the total
value of the building. Yeah, that will be done. That will be done. So that is it about that. Then we come to IAS 32, financial instruments. Now, when it comes to financial instruments, there are a couple of things there. There are a couple of issues there. Let me try if I can collect it. But when it comes to financial instruments, we have types of financial instruments or forms of financial instruments. We have one, financial instruments held for maturity or held to maturity. I'm going to explain that in a moment. We have let me grab a better one. We have financial instruments held to maturity. We have financial instruments for trading purposes. Also purposes. Now, you see, the idea about financial instruments is that there are two things there. Okay? There is what we call financial instruments or financial assets, and there are financial instruments that are what? Liability. Or if you want, equity and liability. What do we mean by that? You see, if a company issue loan notes, so a company issue loan notes, and you go and buy the loan notes, to you, the loan note is an investment, it's an asset, it's an equity. But to the company issuing, it becomes what? A liability. So anytime you are looking at financial instruments, there is an asset on one side and there is what? A liability on the other side. When we say a financial instrument held to maturity, this is the kind of financial instrument where the organization will hold the financial instrument and will not sell it until the date of maturity, irrespective of the price during that period. What do we mean? If I buy shares in a company and it is a held to maturity shares, I said I'm holding that share for 5 years. What financial instrument held to maturity means is that if I bought a shares, 1,000 shares, and I bought it at 1.5, and I said I will sell it in 5 years' time, what it means is that in the second year, even if the share price goes to $10.5, I cannot sell. Why? Because it is a financial instrument held to maturity. So it means it is upon maturity that I can redeem or that I can what? Resell that. But the opposite of that is for trading purposes. For trading purposes, what happens is that you buy the shares or you make the investment because you want to resell. So I bought it and I can resell it at what? Any
So
time.
for maturity you can resell.
Per what?
The first time.
Held to maturity. You know, just at the maturity, not any time that you want, until maturity.
So until maturity is let's say 5 years.
Yeah.
So after 5 years I can sell it.
That's right. But for trading purposes, you bought it because you want to trade, and so you are not committed. So at any point in time, the disposal can be done. But when it comes to financial instruments in reality, there are a couple of things that you need to understand on how to compute financial instrument assets and financial instrument liability. In other words, where a financial instrument has both equity components and then a liability component. That is what refers to as compound financial instruments. Compound financial instruments. So how do you go about that? So I'm going to pull a scenario up Then we're going to use that to solve the question. So a similar question could be asked by the examiner. Jimmy PLC issued a 50 million convertible loan note at an interest rate, let me not use the word interest rate, at a coupon rate of 10%. Similar loan notes without the conversion are at 15%. Are at 15%. So Jimmy PLC issued a $50 million convertible loan note at a coupon rate of 10%. Similar loan notes without the coupon rate are 15%. The loan is redeemable in 5 years' time or could be could be converted into 5,000 $1.5 shares for every 1 million bond required. A. Compute the components of the financial instruments. And I think I'll add a couple of things when I'm solving. So how do we account for this? You see, anytime you see a question of a convertible loan note being issued like this, remember this question that I've put together like this, actually the examiner could take you to that boy, IAS 33, earnings per share. I don't know if you remember, but earnings per share, there is dilution of earnings per share. And one way of dilution of earnings per share is when there is convertible loan notes. And so that could lead us to dilution of earnings per share. So even though the question is a financial instruments question, it could come back to IAS 33 when you're talking about dilution of earnings per share. So how do we solve this question? First, we need to separate the debt into the components, because there is an equity component and there is also what? A liability component. So how do we separate the debt? The first way we do that is to find out what really is happening in the question. So if you look at it, we are told that a $50 million loan has been issued and the coupon rate is 10%. However, listen carefully, similar loan notes without the conversion is at what? 15%. So we're going to put a schedule up, and we're going to put year somewhere. We're going to put cash flows here. We're going to put discount factor here. And we're going to put a present value here. Now, why do we do this? Now, the discount factor we're going to be using is that we will discount the interest and the money receivable at the similar rates. Please get me well. The discount factor we're going to be using here is the similar rates discount. That is at 15%. Now, why do we do that? The reason why we do that is that we have to assume that this debt has no conversion issue. So if it has no conversion, then the actual cost would have been what? 15%. Now, when we say cash flows here, it means the interest that are payable. So in year 1, look at it, I'm working in 3 zeros up. So if I'm working in 3 zeros up, it means we are working in what? Thousands. What is the coupon rate? 10%. So 10% of 50,000, what do I get? So year 1, we will take 5,000. Year 2, 5,000. Year 3, 5,000. Year 4, 5,000. How many years will it be redeemed? In the 5th year, they will take the money plus the interest for the 5th year. So year 5 will be 55,000. Sounds good? Right. Then we bring the discount factor. Remember, it is the coupon rate that we bring in here, but then the discount factor we will use is a similar rate. Now, can we read that? We don't have that to read, but we can calculate, right? The rate, the discount factor rate. 1 plus, so give me the answer, please. 1 over 1 plus 15, right? So 1.15.
0.8696.
3 decimal places. 0.869. Next one.
Okay. Raise the card.
Next one.
Raise the card. 0.656. 0.572.
497.
So let's multiply up.
From below.
Yeah.
27345.
Year 2, 3780.
Year 1 4345.
Year 3, 3280.
Year 4 2860.
So let's get a total.
Four one six one
41610. Now, this 41610 is the debt component or the liability component. Okay? Then you bring the proceeds from the issue. What is the proceeds from the issue? How much are we getting? 50,000. That's the proceeds. When you bring that and you subtract it, the difference will give us the equity component. Sounds good? So what's the difference? 8390. This is the equity component. So separating the debt and equity, say na. Now, this is the first level. So at this stage, what do we do? It's very important. At this stage, what we do is to look at the double entry. So the double entry is that you're going to debit, listen, you issued a bond, so money will come into your business. So you debit your cash book with the $50,000. Remember, we are working in 3 zeros up. Then you credit first debts or liability with 41,610, and then you credit the same time what? Equity. 41,610. So this is what you have to understand. in relation to that. This is what you got to understand. But are we done? No. So, what if what happens if they convert at the 5th year? If they are going to be converting at the 5th year, what is, hey, my mistake. If we are going to convert at the 5th year, what do we do? Now, I could put unwinding strategy here where we unwind this debt up so it gets the 50,000 back. This is what I mean. So we're going to put a schedule up. So we're going to put year here. We're going to put opening balance. We're going to put, now we are assuming that we are making the payments at the end of the year. So we're going to put interest here. Then we're going to put installments here. And then we're going to put the closing balance. Remember, we are still working in 3 zeros up. 3 zeros up at the interest rate. 3 zeros, 3 zeros. Now, so when we are unwinding it, what kind of interest rate do we use? Do we use the 15% or we use the 10%? As you are thinking, I'm writing. So in year 1, the opening balance will be this debt. 41,610. At the end of the 5th year, the figure must add up to give us a total of the 50,000 that we had. So that at the end of the 5th year, that is how much money they will be getting in relation to that. The installment for the 5th year, so 1, 3, 4, 5. 2, 3, 1, 2, 3, 4, 5. So the installment will still be the same. The 5,000 will be paying to them. The same. But in between is where the changes are going to come in. So I'm asking, what kind of interest rate do we use there? Unwinding. The 15%. You want it? So 15%. 15% of this, what do we get?
Should I run it? Or you want
Yeah, to the nearest thousand.
It's 6242.
So add this to this, subtract this, we get a closing. That becomes the opening year. 15% of that. So add, subtract, we get this. Four, 280. 15% of that. 6642. So this plus this minus this.
45922.
So 45922. 15% of that.
6, 8, 8, 8.
Add, subtract.
4, 7, 8, 1,
15% of that. 71. 72. It should give you 50,000. Approximately, right? 50,000. So this is the unwinding. So at the end of the 5th year, the debt is still 50,000. So the question is, remember, the equity is still having that 8390. So the question is, at the end of the 5th year, they will redeem the 50 million. In other words, we will give them $50 million. But they can convert it into a base. So look at what happens on the conversion. So what do you think happens on the conversion? $5,001 shares for every what? 1 million bond. So look at it. For every 1 million bond, so conversion will be equal to 1 million bond, 1 million over, no, sorry, 50 million, the total debt, right? Over 1 million times 5,000 shares. So that's the number of shares they are going to get on conversion. What do I have? 250,000 shares. Now, so for these 250,000 shares, look at it. We're giving it to them at what? $1.5 per share. So the equity of the conversion will be 250,000 times $1.5. What do we get? 375,000. 375,000. But look at something. Look at something. How much do we owe them? What? We owe them 50,000. But look at the equity component. It's 375. Now it's rather unfortunate that the figure is like that because it's just an illustration. But the double entry for this is that we're going to be debiting, look at it, we're going to be debiting the liability, okay, which at the end is now 50,000. We're going to be debiting it with that 50,000. Sorry. So we debit liability to cancel the liability out. Then we credit what? Equity with that shares. 375,000. We are working in thousand, right? So if this is 50, this is 375. You say?
That's 50. That is 50.
Relax. See for me. Okay, maybe let me go this way. Let me go this way. Let me go this way. Because I want the figure to be reasonable. Make this thing 50. Alright, cancel it, make it 50. Or the figure looks too unreasonable. So if you make it 50, what do I get as the number of shares? $250 shares. So 250 shares by this. 375. Is it 2,500 or 250? Charlie, more at the so times 1.5. Mitchell.
3750.
3750, like this. Okay. So this is it's still not reasonable for me with what I want to use. Otherwise, what I want to illustrate here will mix it up. Okay, 3750. Now this 3750 is in 3750,000. No, just 3750. So 3,750. But dollars. But how much do we owe them? We owe them 50,000. So if you check it now, if you check it out, what's the difference? A lot. Give me the figure. 46,250. So look at it. We're going to credit equity with the 3750, and then we credit. Now, when I say equity, I mean stated capital. Then we credit share premium with the difference 46,250. Why share premium? Just say on the issue of this share. Because the some kind of 50 million, but shares no 3750. It's the difference there first one. Sounds good? Now, this equity you put here at the beginning of the day, you won't transfer it. It will still be in equity. It is called undistributed reserve. It will still be there as part of the reserves of the company. So if they convert that equity, you won't do anything to it. It will still be there. And always, it will still be there. Whether you redeem or you convert, it will still be there in relation to it.
So this is the compound financial instrument. And in the compound financial instrument, you've gotten the loan part, which is 41,610, and the equity, which is 8,390. But this aspect of the calculation, we are doing it as though we are converting the whole 50,000 into equity.
Yes.
So this side is different from here.
It's a build-up because you saw that this 41,000 we unwind. So at the end of the day, we will still give them what? The 50 million. Then if they decide to convert the 50 million, this is the effect of it. Now the reason why I'm giving all this is because I don't know what the examiner will say. Right, so that is it about how you do the unwinding. Now, so if they convert, that is the double entry in relation to the conversion. But what if they don't convert and they are redeeming? If they are redeeming, simple, you will be debiting the liability with a 50,000 because you will be cancelling this liability out at the end of the 5th year from the liability account. Then you will credit your cash book with a 50,000 to take it out in relation to that. Because you are paying money out to them, so you credit your cash book. Remember, when you issue the bond, you debited your cash book to receive the money. But at the end of the period, you're going to be crediting your cash book, signifying a redemption of the notes. That's it. So that is it about financial instruments. That's it about financial instruments. So that's the animalistic question that the examiner can set to you that you should answer in relation to.
So if it's not animalistic,
And it is what? Which is?
just one aspect. I know this will be enough one. Okay, if it's just the liability aspect.
Okay, just I still don't get it. Just the liability.
If it's not compound, like you have the equity.
Convert, then it ends here. Then we won't separate to equity and everything. We'll just find this figure, then you unwind. That's all. So that means you will not have any equity and debt. Are you getting the idea? Because the equity and debt is coming in because of the conversion.
And if it's just equity.
If it's just equity, then it will be in a shares form. So the interest component will not come, and that is even easy. Because if you buy shares, what do you do? What's the double entry? If you buy shares, what's the double entry? Debit what? Certainly, you debit investment in shares. It's an investment, it's an asset. So you debit investment in shares, you credit what? Your cash. Then at the end of the year, you have to test for impairment to see if the share value has gone up or has come down. If the share value has come down or gone up, that growth will be transferred to your other comprehensive income as a gain or loss in the year. Then afterwards, when you sell the shares out, you reverse the entries that you made. Are you getting the idea? You debit your cash book, then you credit the equity. Then whatever profit, you recognize it in the income statement. So these are the things about that. Okay, so that is it about the accounting standards. So let's now look at the issue about consolidation.
Oh, the accounting standards.
Is that? Is that?
So accounting standards, the IFRS 15. So you're okay. Yeah.
So it's still called it.
Now what should I call it? And IAS 10.
You shall do console.
Wait, so which one is the IAS 10? Remind me. I'll go and learn it.
Events after reporting period.
Events after.
It's a reading thing. I won't teach that.
No problem. That's the adjusting and non-adjusting.
Yeah.
Okay. Then IAS 12 is what? Taxation.
Income tax.
Income tax. So you're okay with income tax? Scott told you. But when did she say she was called? When she came in?
Can I claim?
Okay, you are married now, so this is Scott. This is Scott. It's you, Papa.
Okay, so let's look at consolidation. Now, at this level, we are dealing with simple group structure. What does that mean? Simple group structure is when a firm buys another firm or has investment in another firm of more than 50%, and then also may have another investment in another firm of say 35% or less than 50%, but more than 25%. Look at it carefully. The P is the parent company having an investment in S, the subsidiary company. So to crunch numbers in, we could say that we have an investment of 70%. If we have an investment of 70%, it means we have acquired what we refer to as control. If we have control, that means that we can prepare consolidated financial statement. Now, immediately we have 70% ownership, that means that our non-controlling interest, NCI, is going to be 30%. In other words, when we are preparing the consolidated financial statement, which means we're going to treat the two entities as though they are what? A single entity. So if we are preparing the consolidated financial statement, because we have acquired control of this firm, we are going to merge their financial statement on a line-by-line item with our financial statement. But there are some when a company has an investment in another company, but that investment is less than 50%, and so with that one, we call it that they have what? Significant influence. Significant influence. Now, how do we account for it? When we acquire control, this subsidiary will be accounted for according to IAS 27. Separate and consolidated financial statement. But where we have significant influence, it is called investment in associates. So we account for it according to IAS 28, and that is investment in associates. But it is very important for us to define what control is. So how do we get control of another firm? There are various ways through which a company can get control of another firm, but in order to find out the definition of control, we will look at another accounting standard called IFRS 10, definition of control. Now, this accounting standard describes the various circumstances under which an entity can control another entity. Traditionally, Control can be obtained by acquisition of 50% or more of the voting rights, of the company. So directly, we buy 50% of more of the voting rights of the companies, then we have control over them. That's the first thing. Another way we could get control based on IFRS 10 is when the acquiring company has less share but has solicited with other minority interests to transfer their voting rights to their company under consideration. So the second scenario is when direct investment is less than 50%, but other minority interests transfers their voting rights. Now, what is the meaning of this? Simple. We have 35% of shares in a company, okay? According to the standard, that investment should be treated as what? An associate. But we have 35%, another company has 40%, another company has 10%, another person has 5%. How much is that? 50, 40. Then another person has 10%. Look at what we are saying here. Transfer of voting rights simply means we having the 35%, then we go and speak to this guy and tell them that, and then including this guy, tell them that, hey, we can better manage your investment for you in this company. So let us vote on your behalf. So we negotiate with them and they transfer their shares to us. So their shares is 25 plus our 55, and that leads us to what? 60%. So now the total voting rights we have in the company is 60%. So even though our direct investment is just 25%, we can still prepare consolidated financial statement because we've gained control by the transfer. That's the second way. Third, another way we could get control or we could gain control is where there is a legislation that requires that a firm of a certain size should treat an investment as a subsidiary. So for instance, we are a listed company and we have shares in an unlisted company. Certainly we know better than them, so maybe legislation could require that even though our investment is less than 35%, we should still treat them as what? A subsidiary. It's a cheat though, but that's the world for you. So they make a peanut investment and they are taking control of the firm. These are some of the ways through which IFRS 10 a company can gain control. Remember, if we have control, then we have to prepare full consolidation. If we don't have control, we need to treat that investment as an associate. In that case, we use what we call the equity method. What is the equity method? The equity method is simply where we say that to get the value of our investment in associate, we use this format. So we bring cost of investment, we bring share of profit from the investment, share of profit or loss, okay? Then we bring any impairment on the investment we have in the associate. If there is any, we subtract. Then we get the value of the associate that will be taken to the consolidated financial statement. So that is what you have to understand about the equity method. So that one is very simple. But the big guy is where we are looking at the issue in relation to control. So let's discuss control. If we have control, what do we do? Now, at this level, there are steps that we go through in relation to preparing a consolidated financial statement. Certainly, the first thing is to establish the group structure. So, what is the group structure about? So, for instance, Yapa PLC acquires 4,000 shares of the 7,000 shares of Rapa PLC. That's it. I just want to illustrate the group structure. So how do we illustrate the group structure in this? If they have a total share of 7,000 and we have acquired 4,000, then we are the parents and they are the subsidiary. How do we know we are the parents? Because we will look at 4,000 over 7,000 times 100%. What do I have? 57%. Which means we have what? Control. So that our NCI will become what? 43%. That is the first thing we establish, the group structure. The group structure also helps us to look at the timing or the period for the acquisition. So that if we acquire the company on 1st April, but their year ended is 30th September, that means this is what? A 6-month acquisition. If it is a 6-month acquisition, then you know that share of profits is going to take only 6 months. If we are preparing consolidated income statement, we'll just take half of all of those figures in relation to that. After we establish the group structure, the next calculation we do is to find out about the net assets. When we say net asset, is about net asset of the subsidiary. So net asset of the subsidiary. So how do we get the net asset of the subsidiary? We bring net asset at acquisition and we bring net asset at year end. Now, what are the things we bring here? One, we bring the issue about their share capital. It's going to be the same.